Hey folks, today I'm diving into why foreign governments are dumping US Treasuries. Let's talk about it. So, US Treasury securities have been a go-to investment for countries like Japan and China. But things are changing. Rising US interest rates are a big deal here. When rates go up, the market value of existing bonds drops, especially if these hikes are unexpected and driven by inflation. Now, let's break this down. A weakening US dollar means that when foreign governments convert their investments back to their own currency, they get less bang for their buck. This is a huge risk for countries with unstable or strengthening currencies. And don't forget about inflation. If inflation rates outpace bond yields, the real returns on these treasuries shrink. Basically, the purchasing power of foreign reserves takes a hit. Political tensions also play a role. Think US debt ceiling debates. These can shake market confidence and disrupt financial access, making it riskier for investors. Liquidity risks during financial crises? Another biggie. Large bondholders might have to sell at lower prices, which can further drag down market values. Japan, for instance, has been a major player in holding US debt. As of September 2024, they're the largest international investor in US government bonds. But this year, we've seen some serious fluctuations. In March, Japan held around $1.87 trillion in US Treasuries. By May, that number had dropped to $1.128 trillion. They sold off $59.5 billion in just 2 months. Japan's investment practices have evolved over decades. Post-World War II, their economy boomed, and by the 1980s, they were one of the largest foreign holders of US debt. Even through economic hiccups, US Treasuries were viewed as a safe bet, but recent years have brought change. Japan's aging population and economic issues like stagflation are pushing major financial institutions to diversify. They're moving away from US and European government bonds, exploring other assets. Rising yields on domestic bonds have made them more attractive. The yen's depreciation has been another catalyst. Japan's Ministry of Finance had to step in, selling US Treasuries to support the yen, which impacts import costs and inflation. This shift could affect the value of the US dollar. A big sell-off could lead to higher Treasury yields, raising US debt servicing costs and reducing the dollar's global appeal. Japan's actions are part of a bigger global trend toward de-dollarization. Other currencies like China's yuan are gaining ground in international trade. This reduces reliance on the dollar. Japan's sales reflect these pressures and a move toward diversification. The EU isn't immune either. Increased selling of EU treasuries could push up yields in European bond markets, raising borrowing costs. This could strain budgets, especially in heavily indebted countries. And let's not overlook the upcoming US presidential election. Vice President Kamala Harris and former President Donald Trump are the leading candidates. Trump's protectionist policies could strain US-Japan trade relations. In contrast, Harris might continue a multilateral approach, stabilizing economic ties. In conclusion, Japan's strategy to cut its holdings in US and EU treasuries is a critical adjustment to global economic trends. This move has the potential to reshape financial landscapes on both sides of the Atlantic. Keep an eye on this, folks. Thanks for watching. Don't forget to like, comment, and subscribe for more updates.